Speaking of Alternatives with Keshav Rajagopalan, Managing Director and Head of Product and Strategy at PGIM Multi-Asset Solutions. Society has an ongoing fundamental need for investment in infrastructure, and this critical area is well suited to the reliability, sophistication, and long-term focus of structured credit financing through private capital. Keshav explores the world of investing in infrastructure with Bill Pappas, Head of Core Infrastructure and Structured Credit at PGIM Private Capital.
Today, we're going to explore the infrastructure landscape. This is a topic I'm particularly excited about, not only because of the intersection of private capital and alternatives, but infrastructure is so tangible. You can look at it, you can feel it, and you can use it. I'm excited to be joined today by Bill Pappas, Managing Director and Head of Core Infrastructure and Structured Credit at PGIM Private Capital. Bill is a veteran of the infrastructure industry. Bill, to start off, let's find out a little bit more about you. Talk to me about how you came to infrastructure, but perhaps broadly, investment, asset management, and what keeps you energized today.
Sure. Thanks, Keshav. Great to be with you. So I spent my career investing in the private markets, and it's been exclusively on the debt side. Early in my career, I focused on broad corporate finance. This was across industries and across the capital structure. And that's really where I had the opportunity to develop core skills as an investor. Around 20 years ago, I had the opportunity to pursue something entrepreneurial, to build out a new platform. This was in a new asset class for our company. It was an extension of corporate credit, but it really was more of a hybrid that involved real assets and sort of brought those two asset classes together in a hybrid format. It really was a precursor to what we see today in broader asset-based finance. In doing that, it really prepared me well to appreciate broader structures, broader opportunity sets, how that interplay plays out between assets and credit, and really helped me develop the skills needed to continue to broaden the mandate that we had in these specialty asset classes. And one of those was infrastructure debt. And this was at a very pivotal point in the markets. It was post-financial crisis. Banks were retrenching, capital standards were shifting, but we really saw a meaningful opportunity for institutional debt to play a very large role. And we saw a lot of good fundamentals. There was a huge funding need. The asset class was very well suited for what insurance companies and other institutional investors look for as far as asset characteristics and investment dynamics. And then later, I started a capability within structured credit. It's been a good ride so far. As far as my own perspective, what's drawn me to this industry, naturally curious, always trying to figure out how something works from a mechanical or structural standpoint. And thankfully, I found a career that values those skills, also asking a lot of questions as well. We always stay challenged in this business. There's so much to learn. Everything is changing. A lot of things stay the same, but there's always new innovations, changing dynamics to make it very interesting. And then when you add to that, what you're doing can meet a major societal need. It's been a very rewarding place for me to spend my career.
Yeah, you can definitely hear the entrepreneurial energy. And you obviously hit on a couple of things that are top of mind for many investors today. Two themes, structured credit, finance. So it'll be good to explore how those themes play out in the infrastructure space. Maybe to jump in then, just to tee this up, a minute to convince me, what's the opportunity here? What should investors be thinking about and what should they be focusing on?
Broadly speaking, whether it's transportation, logistics, social infrastructure, digital infrastructure, energy, all of those broad categories touch on some major themes influencing the world. And you could put them into four different groupings, whether it's digitalization, deglobalization, demographics, and decarbonization. We're seeing greater need for private capital solutions in all of those dimensions. It's really to be able to meet the sheer demand from those drivers. You need tailored solutions beyond what traditional bank capital can provide and beyond what the public markets can provide. So private capital, whether on the equity side or debt side, is very well suited for this. And infrastructure plays very well into those themes. From an investor standpoint, you referenced it in your introduction. It's tangible. Investors can experience it physically, understand the critical need for it, and understand the societal need more broadly. And that can be pretty compelling when you're thinking about assets on a very large scale, but also bringing that back to a local basis as far as critical infrastructure in smaller markets and smaller assets. And it provides benefits that investors appreciate. It's got a good long-term track record as far as a return profile. It's got lower risk and volatility relative to other asset classes, and that really makes it stand up very well within a portfolio.
Infrastructure is a complex area with extensive ongoing demand for financing. As such, it can benefit from both public and private sources of funding. But with that come challenges, such as navigating political and regulatory issues,
Well, a compelling case there, Bill, but let's dive a little deeper. We always like to start by unpacking a headline, something people are talking about. And today we found a survey from IPE Real Assets. The survey asked about 100 of the largest institutional infrastructure investors globally for their perspectives and outlooks on the asset class. And there was a particular survey response, perhaps not surprisingly, but it stood out to me and something to get your perspective on. When asked what are the biggest obstacles in investing in infrastructure today, political and regulatory uncertainty topped the list. Does that ring true to you? And how do you think about navigating the risk around political and regulatory uncertainty?
That's a great point, Keshav. Very much top of mind. Let me take a step back. The fundamental issue remains there's a huge investment need. That's happening worldwide. We see that dynamic playing out, and consistently there's limited resources to address it from a public funding standpoint. So private capital is very well suited to play some sort of solution there. But from a public standpoint, as government entities are looking at the asset classes and what the needs are and where the capital's got to come from and what the other alternatives are, if they can engage with private capital, it would mean raising taxes. It would mean raising user fees. And that's a very delicate balance that is difficult to navigate. Neither one of those is particularly attractive. So there's got to be other ways to be able to incentivize the investment and bring capital to be part of the solution from private sources. So why is private capital well suited for this? As I've noted, it can bring additional capital to the equation. It can bring efficiency and cost savings. It's got a good track record of improving infrastructure. This can be done in ways maybe that a purely government-funded solution can't do, and the public really sees value to it. But there's user price sensitivity to consider. And this dynamic plays out across markets pretty consistently as far as how different segments of the population may view the role of private capital and the role of infrastructure improvement and what that means to them directly on a day-to-day basis. There are some that don't care who owns the assets, private, public, government, etc. They're willing to pay more for quality. Others who are sensitive to paying more under any circumstances, doesn't matter. This is what they're used to paying, and this is all that they'll be happy with, regardless of the asset quality improvement. And then there's another segment that's very focused on environmental factors, and infrastructure is striving to be a lot more sustainable. And those users are willing to pay more as long as the environmental considerations are front and center. Private capital deployed the right way can be a really valuable part of the solution. Doesn't have to be the sole solution, but can team up with governments very well in certain circumstances, even short of a full privatization, to add value to this equation.
So you've touched on something that's obviously really interesting about this asset class, just the interplay of public and private. But I'm sure there are regional nuances, and that's why it makes infrastructure investing so localized. Maybe talk a little bit about what's happening in the U.S., and then we can hit on some of the other markets around the world.
Sure. U.S., very interesting place to start. Obviously, we've got the incoming administration, and I think the expectation is that we're going to see very much accelerated change. Everything's got to get done within the next 18 months, because after that, you've got the midterm elections, and then everybody's going to be focused on the next election. So now it's really the time for action. And you can see that as far as how quickly the administration is putting the pieces together, getting things started, and putting the wheels in motion. And so what we expect to see immediately or in the really near term is things like permitting reform. We'll see projects getting approved more quickly. We'll see more steps towards deregulation. All of that will free up development. That's the objective. You'll see commercial development happening around key infrastructure assets. So it'll be a very interesting landscape. And the goal is that we can have the private sector play a much larger role in adding in new development and being part of the infrastructure solution. From a legislative standpoint, I think the expectation is that we'll see the bipartisan infrastructure law stay intact, but that only gets us part of the way. Between the Inflation Reduction Act, the CHIPS Act, and the infrastructure law, all of those account for over $1 trillion in federal spending. But the reality is that the infrastructure deficit that we have in the United States is multiples of that. So there's still a big hole to fill. To really put that into perspective, the U.S. spends about 0.5% of GDP on infrastructure. From a global perspective, that's half the level that the UK and Japan spend, and it's 1/3 the level of what Australia spends. So we have a lot of ground to make up.
Globally, infrastructure remains essential to society and complex. It requires a deep understanding and the ability to manage a variety of external forces, including diverse governmental regulatory issues, economic forces, and geopolitics.
It's interesting. It sounds like the U.S. landscape, there's a lot to turbocharge infrastructure spending. Obviously, all the legislation that was passed, but now the change in administration and regulatory stance. But there's still such a dearth of infrastructure spending here in the United States that we've got a lot of catching up to do. So talk to me a little bit about what's happening, at least across the pond in Europe and the UK.
Yeah, that's a good place to start as well. Clearly, we see a lot of pressure on the regulators. That's playing out in a number of sectors. The pressure is to control costs, manage customer bills, but also balance that need to incentivize capital to come in to invest and be part of the solution. So the systems badly need it, whether it's water supply, power, etc., but it's a difficult balance to strike across all those factors. So we're seeing that play out, and that's top of mind for the public. And then we also see a lot of political upheaval to make the equation even more complex. You're seeing that playing out in France and Germany and now Canada. And then you can add into that China, Taiwan, and Russia, Ukraine. The geopolitical landscape is more complex and dynamic and challenging than any time we've seen in recent times. But if you do take a step back, you see that the supply of capital is there in the private sector. You see that the need is there. You see a real impetus to drive improvement in investment and asset quality. And yes, that regulatory uncertainty and those political challenges exist, but the base need and fundamentals remain sound.
Lots to navigate, and maybe we'll dive a little deeper as we pivot towards unpacking some of the headwinds. So what are the critical issues your investment teams are thinking about in terms of what they need to navigate in terms of headwinds?
With that economic and geopolitical uncertainty, add to that the threat of tariffs compounding the issue. What does that mean for global trade? How secure does your supply chain need to be? And how are you going to go about making sure that happens? You look at the disruptions in trade routes. Obviously, a real situation that many have been experiencing is security issues in the Red Sea and the impact on the Suez Canal. That's impacting the Asia to Europe shipping trade. The alternative there is to divert the ship. And what you're seeing now is the ships being forced to be rerouted around the southern tip of Africa. And that's a longer journey, and it's around 3 times the cost. So that's changing the dynamic within shipping. And it's also extending times, and it's forcing consumers, industrials, and corporates to even do further planning to allow for those types of disruptions and extended time periods and extended cost. Those are just a few examples. All these dynamics play well into that theme of onshoring. Enhancing infrastructure provides certainty, and I think that's what a lot of users are looking for. And with that certainty, you can better accommodate the volatility and disruption that we're seeing around the world.
Energy demands are an enormous driver of infrastructure. Critical considerations that come into play in sourcing and securing energy supply include sustainability and reliability, as well as efficiency.
So obviously a lot with geopolitics playing a role in this, but as you point out, some of these headwinds can turn into tailwinds. Let's pivot to energy. Energy is going to come up, obviously, around infrastructure and many conversations you're probably having. What's some of the different complexities there to navigate and the opportunities that result?
From an energy standpoint, it's really about power supply and energy transition. In terms of demand, it's massive. But how is the supply going to be there to meet it? That's where everybody is focused. How will that huge requirement for power be met? You've got increasing digitization of our lives. How will we meet that in a sustainable and repeatable way? If you look at demand from data centers driven by artificial intelligence, you look at expanded electrification, the need is massive. In the U.S., data center demand is expected to grow 20% a year through the end of the decade. And the U.S. is short 50 gigawatts in data center capacity. So that's what's driving that growth. That's why we have such a huge need. So that 50 gigawatt need in data center capacity equates to around a $50 billion investment need. And all of that is going to have to be supplied by capable power sources. It's got to come from sources across the spectrum. It can not only be a single source. You can look in the case of Exxon. This is a recent development. They just announced a massive investment to build a gas-fired power plant solely to supply the data center market. And with that, it's also going to be 90% capture on CO2 emissions. So that's a real landmark event occurring. First time that Exxon will be building a power plant, not to supply its own operations, but this will be done exclusively to supply data centers given the need. Another area of potential weakness, though, and vulnerability is the grid. The metric is for every dollar of investment that is put towards generation, you've got to also make a dollar investment that's put towards storage. And right now, the U.S. is at 60 cents. So a huge gap there as to what's really needed to accommodate this and make it work efficiently. And interestingly, the Exxon case, that gas-fired power plant is not going to be connected to the grid, so totally bypassing. And this is just the U.S. market. All of these present opportunity for private capital to play a role, but you really do need to have that asset expertise and you really do need to have that local knowledge in order to be able to deploy the capital smartly and efficiently.
So it sounds like both geopolitics, energy, a lot of complexity, a lot of challenge, but obviously for investors that breeds opportunity. What are other tailwinds to touch on just to round it out?
Well, the spectrum of infrastructure is growing. And as an investor, you really need to be disciplined about how you define it. At its most basic level, it's assets with long economic lives that provide essential services that have high barriers to entry and predictable cash flow streams. That's core infrastructure, and that's the essence of what we do. There's a lot of adjacent assets that can really make the system a lot more efficient, that may also be part of the broader physical presence within that port or airport that really make the supply chain, transportation, and logistics a lot more efficient to be intertwined and connected. So there are a lot of opportunities that are adjacent to classic core infrastructure that also play a critical role. Some major ones would include logistics and supply chain, and these go well beyond the capital city ports and airports that many investors are used to investing in. And these represent additional opportunities for growth and investment and capital deployment. And all of these assets are transforming through technology. That's playing a much larger role. So there's opportunities to invest there. And all of the assets are also repositioning regarding sustainability to improve their environmental impact and improve their environmental footprint. You can see a very real example in a lot of UK ports. You've got port infrastructure that was previously dedicated to coal transportation for power, and now those assets are being redeployed. They're supplying vessels and supplying components to support the offshore wind business. So that's a very real transformation and has a meaningful environmental impact and speaks to the sustainability and the importance of those assets and the role that they can play as far as being part of the solution.
What always surprises me is just how vast infrastructure investing in. And one thing you haven't touched on quite yet in depth, but would love to hear about is digital infrastructure.
Digital is really now the fourth utility. Whether you're talking about wireless infrastructure, data centers, fiber optics, broadband, towers, there's meaningful opportunities to invest in all those sectors, and they're all growing. So that'll be a big area of focus for investors, and that's not slowing down. But you can also think about the mundane assets like parking. But those assets are going through a real transformation, whether it's the impact from electrification, whether it's from automated driving, trucks, all those are playing a role into how these assets are being repositioned. So there's clearly additional capital needs there, but also additional revenue opportunities that can result from that investment.
Investing in infrastructure takes a certain level of expertise and the ability to navigate nuanced, dynamic, and variable markets. Opportunities span international markets, but having local insights is highly advantageous.
Before we pivot to what capital allocators are thinking about, what are some of the capital seekers? If you're seeking capital in the space, what are you prioritizing when you're interacting with your team?
Asset owners and investors that we interact with all want capital solutions that encompass a broader landscape. All of the needs are very nuanced, and they want flexibility. They want investors and partners that have asset expertise. They want them to understand the local dynamics and the ability to balance risk and reward. I think that's critical. And you've got to be positioned to know when the dynamic is attractive or when it's not, and not to be too influenced in your investment activity by current themes of the day and playing into that on a basis that really is not going to be economically viable in the longer term.
Taking the other side of the coin, we always like to get input from our PGIM distribution teams on what they're hearing from our clients. So we've asked them to gather a few questions from the floor. So to tee up one of those now, what are you hearing from your clients on the asset allocator side in terms of what they're looking for in the infrastructure space broadly? Where's the demand signal coming from?
What we're seeing around the world is that institutional investors want to invest both within their own markets and also across markets. Managers need to be able to navigate through that complexity to be able to draw the proper inferences across markets to make a smart investment case and take advantage of the opportunities and understand and be positioned to capitalize on the changes and also manage the risks that are inherent. And that may be very different depending upon market dynamics. You see very different investor landscape, for example, in fiber networks in certain countries within Europe than you might see within the US. And that sector is evolving. Additionally, different frameworks, different pace of development, and different stage within their own development cycle all have to be considered as you're thinking about the proper investment case for the right type of risk that the investors are seeking.
So it sounds like demand is global, but a lot of local nuances required to really understand the opportunity set. Maybe the other piece to this is something we started off at the top of the conversation, but it's also the structuring side of this. And that's where infrastructure lends itself to interesting capital solutions for investors. So what are you seeing in the ABF space and structured credit space? And then how's the role of private equity also coming into play here in infrastructure investing broadly?
We're seeing continued growth in investment that's driven by private equity. That's been a massive dynamic that's influencing the markets, whether it's infrastructure, asset-based finance, other structured solutions. Private equity is playing a large role in expanding those markets and bringing other investor sources of capital into the mix. And then also providing a broader range of solutions to the end users of that capital. So you see that extending from the largest corporate names who are looking for tailored solutions, whether from JVs or other special investment situations. They've got to meet the massive capital needs for their corporate-owned infrastructure. And that's driven by the same factors we had noted earlier, but digital infrastructure, power, chips, broadband. Many of those are owned by private entities, by corporations, and they really need the access to a broader source of capital that can be driven by private equity, but also other private asset classes as well to support it. But from an investor standpoint, the key is, how do you manage that? How do you segment the risk? Markets are adapting and becoming a lot more efficient in that realm. And you're able to see opportunities where the risks of development and deployment of new assets can be isolated away from the risks that would exist for a very mature network within these sectors. Then you've got to be able to access multiple sources of capital to be able to meet that need efficiently. A great example of an asset class that's using more segments of the capital market than any I've ever seen is data center finance.
Maybe to wrap up with the final question from the floor, what are clients asking you about in terms of the role of infrastructure in their portfolio? Yes, it's the investment opportunities within the asset class, but what is the asset class itself doing within a portfolio? And what are you hearing from clients on how they're thinking about this from an asset allocation perspective? It
really depends on the unique needs of the investor and whether that's from a duration perspective, return target, or risk dynamic. If you look in the case of pensions or insurance companies, generally they want long duration, they want credit stability, and many of them are looking to match long-dated liabilities within their portfolios. So infrastructure is very well suited for those use cases, and many of those might be focused exclusively on investment-grade infrastructure. That risk consideration as to where you focus your activity is important. So what helps to differentiate infrastructure is that you have the opportunity to go down in the credit spectrum, whether you're talking about lower investment grade or higher below investment grade quality, capture additional returns, but also not be exposed to materially more risk. And that's because of the favorable risk-adjusted returns relative to other asset classes, specifically higher recovery that plays into that and lower losses and lower volatility. So that's the case whether you're talking about investment grade, highest quality, but also is the case as you go further down the credit spectrum as far as that differential relative to other asset classes. It really stands out in infrastructure. What we think is particularly attractive is that lower investment grade and higher below investment grade space because of the dynamics and the pricing premium and the investor protections that can be built into those types of transactions via covenants and other structural elements.
Maybe just as a quick follow, you started your career in corporate credit. Give me kind of the comparison of infrastructure investing and the role in a portfolio versus a corporate credit. Obviously, there's the cash flow piece, which I think a lot of investors focus on, is the ability to use infrastructure from a cash flow match perspective. But what are some other things to think about vis-a-vis corporate credits?
That's an interesting one, and certainly seeing this play out more meaningfully over the past few years. The inflation linkage, that's a key consideration. In corporate credit, you've got pretty widespread costs of key inputs going up, raw materials, labor, et cetera. And in many cases, those price increases are difficult to pass along in full. Clearly, there are price increases that we're all experiencing now, but the fundamental is that the real costs are going up on a much larger scale than consumers are seeing on an end pricing basis. So what you're seeing is margin pressure impacting corporates, but that's a common theme. In infrastructure, what you see is a lot more margin resiliency, and you also have limited price elasticity just given the nature of those infrastructure assets. You also have additional downside protection with these investments because many of them are contractually based with their customers. And so the revenue sources can be structured such that there's a minimum level of payments regardless of the volumes within that asset. You can think about a landlord port in the UK or Australia. Those port owners serve as landlords and have contracts with their customers that call for minimum payments that are due regardless of the volumes that those customers bring through those ports. So it really can mute out any revenue volatility that might result from changes in volumes. And all of this leads to diversification, with infrastructure accompanying corporate credit risk within a portfolio. You've got that inflation balance, underlying asset resilience, and stability for investors. All of that presents a very interesting dynamic.
Well, Bill, fascinating conversation on a fascinating asset class. Obviously, a lot of complexity here, so I'm going to try to simplify with 3 of my takeaways of what stood out to me. Number 1, the fact that so much of infrastructure investing is also driven by external factors. I think you started the conversation with what I view as the 4 big Ds, but the themes that are occurring outside of the infrastructure space, but obviously having a direct impact on it, being digitalization, deglobalization, demographics, and decarbonization. You couple that out with the regulatory outlook, and there's a lot of complexity, but then opportunity for investors to wade through. Number two, to me, was just the breadth of infrastructure investing. I don't think I quite appreciated and understood how varied it is. And that's both from a sub-asset class perspective, but also geographically. And that's where I think it really does lead to localized knowledge that's so important. And then three is everything we just wrapped up with. But infrastructure in a portfolio plays such an important role because they're structuring solutions. Themes that we're hearing on structured credit, asset-backed finance are inherent to infrastructure, and that's what allows it to play such an important role in a portfolio. So again, a really fascinating conversation, and thanks for unpacking so much with us.
Thanks, Keshav.
Well, Bill, it's been a real pleasure having you on today. For everyone else, thanks for listening. Join us next time on Speaking of Alternatives.
Speaking of Alternatives with Keshav Rajagopalan, a podcast from PGIM. Follow, subscribe, and if you like what you hear, go ahead and give us a review. And be sure to look for the podcast The Outthinking Investor, also from PGIM. This podcast is intended solely for professional investor use. Past performance is not a guarantee of future results. All investments involve risk, including the loss of capital. PGIM is not acting as your fiduciary. The contents are for informational purposes only, are based on information available when created, and are subject to change. It is not intended as investment, legal, or tax advice and does not consider our recipients' financial objectives. This podcast includes the views and opinions of the authors and may not reflect PGIM's views. PGIM and its related entities may make investment decisions that are inconsistent with the views expressed herein. This podcast should not be reproduced without PGIM's prior written consent. No liability is accepted for any direct, indirect, or consequential loss that may arise from any use of the information contained in or derived from this podcast. This material is not for distribution to any recipient located in any jurisdiction where such distribution is unlawful. PGIM is the global asset management business of Prudential Financial Incorporated, which is not affiliated in any manner with Prudential plc, incorporated in the United Kingdom, or with Prudential Assurance Company, a subsidiary of M&G plc, incorporated in the United Kingdom. Copyright 2024. The PGIM logo and the rock symbols are service marks of PGIM's parent and its related entities, registered in many jurisdictions worldwide.